This is Money Stories.
Brought to you by Amy and Ben from In Financial Services. Today, we're joined by Dan Walsh for a special episode, Money Questions. Dan shares with us today his 3 pillars for setting up your finances. Okay, welcome back to Money Stories. I'm Ben, and today I'm joined with Dan in the hot seat, in one of the host seats.
Hot seat, I like it.
And we've also got Janine with us here today.
Hello.
In the Money Story seat. But we're going to do things a bit differently this time. So off the back of one of Dan's episodes where he went over his money stories, there was a bit of gold at the end that we really wanted to...
We want the gold. We want more information on the gold, please.
Yeah, we wanted to really unpack it and sort of go into it in more detail that we didn't have time for in your money story. So you're in the host seat now, and Janine and I will fire away some questions at you. But yeah, so I guess just to start with, to get us kicked off, for those who didn't see the last episode, at the end you touched on the pillars of setting up your foundations so you could get started in investing or just in wealth creation in general.
And probably from a financial planning point of view.
Yeah. So, I guess I'll leave it up to you to take us away. But, if you want to sort of tell us about those pillars and how you can start that.
Yeah, look, I've been advising for close to 25 years, and whenever I have a new client that comes in and sees me, inevitably what they want to do is they want to get to the fun stuff. Right, the fun stuff is the wealth accumulation, right? It's the sexy stuff. I want to buy the investment property, buy the stocks. I'm making good decisions. Endorphins are flowing. This is all good. What they inevitably forget is life isn't always rosy. And sometimes, there's curveballs that can get thrown at us, but that's one aspect of it. But there's also habits around money that we need to account for. So I've always found the foundations are probably... a financial plan's built in tiers, right? And if you think of it as a pyramid, my base foundations are going to be 3 key things. You need to have your habits around debt and cash flow under control. So I'm talking about, and we could probably dive in deeper on this, but we're talking about understanding debt and repayments. Yes, that's a no-brainer. But you've got to understand where your cash flow is going and what you're spending it on. And so you're not overextending, and more importantly, that you're starting to pay yourself first and all those sorts of things. So debt and cash flow for me, critical. The second step to that would be wills and estates. It's something that people don't really like to talk about, but if life really throws you a curveball and something unfortunate happens and you die, you got to make sure that your family's protected, right? So we're talking about what do we do with all the stuff that you've accumulated when you die, and how do we pass that on to the right people at the right time? So we're talking about asset protection, and we're talking about tax efficiency post somebody's death. So wills and estates, debt, cash flow, and number 3 is absolutely around wealth protection, specifically insurance. Right? So insurance is about what do you do if you can't turn up and go to work tomorrow? And I would say that the definition of financial independence would be that point where passive income meets or exceeds personal exertion. If you haven't reached that point of financial independence, insurance should be on the table as a means of mitigating risk and transferring that risk to another party, i.e. an insurer. Yeah. Once you get those 3 foundations right, now we're ready to have a conversation about building wealth, borrowing money, buying properties, getting to all that stuff. Yeah.
And those 3 foundations, are they each important as each other?
Yes.
Yeah. So if you don't have one of them, that could crumble your whole
Absolutely.
Whole base.
Yeah. Now, most people will think, well, if you die without a will, you have to go through probate, and there's a pecking order depending on what state you live. It goes to your spouse and your kids and brother and siblings and stuff like that. So, your assets could still be distributed in accordance with your wishes. That could still happen, but your family has to go through some pain and heartache to sort that out. Just don't put that on another family member.
So I suppose it's probably the best idea to break it down and go through each individual stage in a little bit more detail.
Yeah. Let's break down each of the pillars.
Yeah.
Okay. Don't try and do too much at once.
Yeah, exactly. Yeah.
So, do you want to
tell us
about the cash flow pillar?
Okay.
And of course, each of them could have their own whole podcast.
Yeah.
Because they're all so big and you can go into so much detail. But yeah, we'll just try and like go
But
through
yeah,
it.
this will just be the basics of each pillar.
Just a little bit of like, so you can think about it.
Yeah.
Yeah, okay. So I guess my first thing that I would probably impart on cash flow is we're not talking about gross income, tax, net income. I don't really care about your gross income. I'll leave that to your accountant. What I care about is what is your net income and what are you doing with it? What's coming into the household? I want to understand your habits around money. And so that's the first thing. You've got to have a bit of visibility around that. The second thing to understand with cash flow is that it'll rule everything you do.
Yeah.
Everything we do comes back to our cash flow. How much do I got to pay out of my back pocket to go do X? Buy a home, go on a holiday, buy the groceries, always comes down to cash flow. So you really need to get into a position where I believe where you automate your cash flow model.
Yeah.
And that involves a number of things. First of all, you've got to segregate your fixed cost of living, let's call that bills, with your discretionary spend, let's call that living. And only then can we start talking about building a savings component into that. So I always sort of favour a cash flow model that's simple. It's got to be easy. And easy is very different than being easier.
Yeah.
Okay? There's a difference. It's got to be easy. So I just use a basic three account model. And my first cash account would be what I would call an income account.
Yep.
And all the income falls into that one income account. And that's what it does, right? You don't live out of it. You don't have a key card on it. I don't want you paying your mortgage out of it. It's just to capture income.
Yeah.
From there, we're going to retain some of that. We're going to take the methodology of I'm going to pay myself first, right? So this is the whole comment we had on the last show, which was 10% of what you earn is yours to keep, right?
Yeah.
So in other words, you could look at it and say, well, 90% of what I earn is there to cover my fixed cost of living and my discretionary spending. We won't get into how we break those two up, but you can sort of, work through that. And what will inevitably happen is that income account is going to play a key role for multiple things, right? First of all, it's going to be your cash reserve bucket. This is your emergency fund that if I can't work for a short period of time, my family can still eat, I can still pay my mortgage repayments.
Yep.
Call that 3 months worth of cost of living. Other than that, you can get insurance to take over from there. But 3 months is your mandated minimum for mine.
Yeah.
And from there, what happens is over time, we start to earn more income. We get pay rises, which is nice. And if all that income's getting dropped into one account, we don't just get a pay rise. If we're just living and eating out of one account, people just consume that extra income because life's just got a way of absorbing our cash flow, right? Cost of living is expensive unless you oppose it. And opposing it is difficult and it's also easy. The easiest way I think to oppose it is to take it away from yourself and automate it. That's how I would do it.
Yeah, cool. No, that's a great setup. That's good.
And the kicker beyond that is once you've got your cash reserve, call it 3 months cost of living, call it 6, whatever you decide to do, think of it as a bucket. Yep. Now that bucket's full, it starts to overflow.
Yeah.
Let's take that overflow that you're saving now and let's go buy some investments because your cash flow's under control. You've proven to yourself that you can live on what you've got left, right? And that you're regularly saving. Let's go buy an investment property. Let's buy some stocks. Let's put some extra off the mortgage or put something super.
Yeah. And with that overflow, would you just leave that in that main income account?
No, I probably wouldn't actually. I would suggest that people go talk to their broker and get some good debt structuring advice from their broker around setting up the right loan account to leverage from that. So what I'm talking about here is what most people would know is a basic principal and interest home loan. Very cheap, very simple. It's your traditional 25-year home loan. Just pay it off, regular monthly payments. With an offset account, you can have the exact same loan structure, still make your regular repayments. The difference being is they attach a bank account to that home loan now.
Yeah.
So any savings in that account offsets the interest you pay. So if you've got 100 grand in a savings account, 500 grand mortgage, yes, you've still got to make your principal interest payments. However, as you guys know, you're only paying interest on the difference now being 400. So more of your money is going spent off principal than any interest. I would use that as my offset account off my mortgage, and then you're getting multiple benefits from your savings for sure.
Yep.
And I suppose because I've been in a lot of meetings with you in relation to financial planning and clients, and it's interesting how you'll have clients that think that they might save X amount of dollars per year, but then when you actually physically work it out, and just ask a simple question in relation to, well, how much is in your bank account a year ago compared to how much is in your bank account now?
Yeah.
And then you find out it's the same or very similar. Like, okay, well, have you saved anything off the back of that? And the answer is...
Well, I actually I do an exercise with a client where I get them to draw me on a whiteboard what they actually do with their money.
Yeah.
Draw a square for your bank account, how much income's going in there. Now draw me where it goes. Give me a flow chart. How much do you pay off the mortgage? How much for the Christmas club, kids account, whatever it is. And inevitably what is common, you're right, is that they say, look, I want to buy an investment property. Can you afford to? Yeah, I think I can. I said, well,
show me.
You think you can, or can we? Let's have a look at that, right? So ultimately, once we break down, remember we were talking about habits around money. Yeah. I don't care what you tell me, I care about what you do. That's probably the foundation to that. I don't care what you tell me, I care about what you do. So once we draw this sort of diagram out on a sheet of paper, a whiteboard, however works for you, you'll start to see where it all flows. Now, if you've got direct debits going to bills accounts, kids accounts, Christmas clubs and home loans, and that all adds up to 50% of your net income, and your savings in the bank is zero, or your balance is not much, there's your cost of living. You're spending what you're earning. So here's a classic conversation that we then have is, you're currently spending your net income. What are you prepared to give up to get X? And that's one of the best questions I ever asked a client. It's one of the best questions I ever got asked by my mentor.
Yeah.
Everything's a trade-off.
Yeah, definitely. Righto, well that's...
So then we get that one all
that's,
sorted.
pretty much the cash flow side of things
I think so.
sorted out, or the basics of it. So then you've got your second pillar, it was your wills and estates.
Look, your will take a meeting with a solicitor. It's very, very easy to do. I would probably suggest that there's two broad types of wills that we're talking of, right, when you're trying to set this up for yourself. One is what I refer to as a simple will. I refer to as an I love you will. Right? So mum and dad, 2 kids, let's use that scenario. Dad dies, I love you, dear, here's all my money.
Yep.
Mum's now got this pot of money because we've got some insurance and the house and some other assets. And now mum's got to go and try and invest that money to put food on the table. We've got an awkward situation here, though, because children under 18 in Australia that earn passive income, like investment income, $416 tax-free, pay 66 cents in the dollar after that. A rip.
Yeah.
Like it's the old days, right? Parents used to just 13 kids and stuff investments in their kids' names to avoid tax. Can't do that anymore, right? That's just a thing of the past. So that structure has got zero tax effectiveness to it. The second piece to that puzzle is, what if mum then meets a new partner? That relationship's going nice and great. That relationship breaks down, turns to shit. And all of a sudden now the assets that dad's left mum is now up in a dispute and a risk, right? Because we know de facto married makes no difference these days.
Yeah.
Okay? So there's little asset protection with it, and there's little tax effectiveness with a traditional simple will.
Yeah.
Okay? A simple will is better than having no will, I will say that.
Yeah.
But what solicitors can do these days, and you do need a good solicitor with this, is they have what we call a flexible will. And they use this funny trust, right? It's called a testamentary trust, but I refer to it as a flexible will. And ultimately what happens is, in this scenario, dad still dies, but all the money falls into this trust, right? And it's not a living, breathing entity, understand. It's just you've got the option to trigger this trust written in your will.
Yeah.
But you can't set it up after you die. Okay, you have to write it into your will, which is why it's in the estate planning realm. So all this money falls into the trust, and 2 key things happen here. One, children under trust law aren't recognised as minors anymore, so all of a sudden the kids get $18,200 tax-free, just like mum and dad do. So we've now got 2 kids and mum at 18 grand tax-free each. We're talking like, what, $54,000 tax-free. I would set that will up just for the tax benefit alone.
Yeah.
And then we've got the asset protection is that, mum meets the new partner, that breaks down. All of a sudden, the different conversations, now mum doesn't own the money.
Yeah.
She's a beneficiary of it.
Yeah.
It's a different conversation, yeah? And even if your children go and start a business and go bankrupt, got a better asset protection in a trust than you do in your own name.
And so when do you think that a person should set a will up?
I actually think people should set a will up when they start to generate some assets. Like the no-brainer is when you buy a home, you start accumulating savings, and you've got superannuation, all that sort of stuff. But keep in mind that not every asset that we buy falls through to the will. So this is a property conversation around joint assets and tenants in common. I don't know, we'll get into that today. But
And then I suppose then you could also then, make mention of the fact that when wills stop being enforced in relation to if a person gets there and gets married or...
Yeah, marriage or divorce means your will's null and void. So I always recommend to people is I use an Olympic Games strategy here. I've said this before. Every time an Olympic game comes around, I just stress test my will every 4 years. That's probably enough. And, I haven't had to change it in some time. But if you do get married, get divorced, you absolutely need to update it.
Yeah, cool. Righto.
I think that's all we need for that one.
That's probably all we need for that one. And then pillar 3, so that's your debt protection, was it?
Yeah, wealth protection. And this is by and large, when we talk about wealth protection, understand we're talking about what risks are you exposed to in your financial plan, and what are those risks are you going to retain yourself? What's the strategy to retain it? And what are you going to transfer on to somebody else? So your first big risk that I see in any financial plan is the reliance upon income. It's a huge risk, right?
Definitely.
You're starting to accumulate savings and you're paying off mortgages, you're going on holidays, raising kids. We haven't even talked about buying and gearing into property yet, right? And all of that relies upon somebody generating an income, whether you're self-employed or employed by somebody else, doesn't matter. You're relying upon you getting up, going to work and earning income.
And then you have some children, one person stops working, the other person continues to work, their income increases.
Yeah. It's the biggest risk that I see, and funny enough, it's unfortunately one of the risks that I often see overlooked. It scares the hell out of me, right? So there is insurances in place. You can transfer a lot of this risk to an insurance company, like it's life insurance, right? If you die, here's a lump sum of money. And that lump sum of money can be used for 2 key things. You use it for lots of things, but keep it simple. There's 2 key things: debt and income. So if you die, debts die. There's my mandated minimum for anybody. Don't die and leave debts to your family. It's freaking heartbreaking, right? The second thing is if you're no longer here now and the family's reliant upon your income, what capital amount do you need to go and invest to draw an income from? That is absolute risk transfer. And every time I have these conversations, not every time, but a lot of times I have these conversations with people over the years, one of the pushbacks that I always get is insurance is expensive. And my classic question is, compared to what? I'm serious. Compared to what?
True, that's right.
Because if we're talking, and we've talked about this before, Ben, like if you've got a $500,000 mortgage paying 6% interest, let's not even get into P&I. Interest only, $30,000 a year to pay your mortgage. Insurance doesn't cost $30,000 a year, right? It might cost you bloody $1,000. Like you can buy it inside your super fund, for God's sake. So, get some insurance in place, transfer the risk to somebody else, do the right thing by your family, because to not is just honestly, it's just downright irresponsible.
And just touching on what you said there, like buying it inside your super fund. So sometimes you don't even have to...
Or inside your super.
Or inside your super, So a lot of the time you don't even have to... Like you are making those payments because they're coming out of your super, but like they're not actually coming out of your back pocket.
Well, yes, you're right. So it's a conversation around, yes, you're paying for it. Because it's your nest egg.
Exactly.
You own that super, it's your money. So yes, you're absolutely paying for it. Be mindful of what you're paying. But it doesn't impact cash flow especially when you're younger and you're trying to get ahead in life and pay your mortgage and raise kids. The second piece to that, though, if you own, say, life insurance inside a super fund, which every super fund offers, you can actually sacrifice some income. So we call it salary sacrifice, but you can make contributions to super, as you know, in pre-tax dollars to pay your premium. It's a very tax-effective way to pay for your life insurance, making it even more affordable than what it is. You're right.
But it's one of those things that are extremely important, especially when you have young children. You've got the mother that might be working part-time. You've got the husband that's going off to work. Something happens to him. You've got this house that's got this debt associated with it.
Yeah.
You're not working full time. You don't have the ability to work full time because you still have to raise children.
Yeah.
And how do you continue to live
That's
a
right.
semi-decent lifestyle? So it's the last thing that you want to have to be dealing with when something goes wrong.
Yeah. And I would even say over life insurance, which is a lump sum if you die, you've got to have some income protection.
Yeah,
So
yeah.
this is a regular monthly income that you get paid in the event you're sick and injured for a period of time and can't work. It's a temporary payment. Once your doctor says, hey, Ben, you're good to go back to work, you're healthy, they'll stop paying you, which is fine. You're back earning income.
Yeah, exactly.
So completely different to the life insurance and a complete separate different payment is what you're saying.
Yeah, it totally is. Yeah. And just as important.
Yeah.
Yeah. And two things for that. When would you set it up? And do you have the same Olympic Games strategy for
Yeah,
reviewing
good
that?
question.
Yeah. Income protection, I would set up the day I am 18 and I'm working full-time and earning income. No brainer for me, because even young people, like if I would encourage parents out there to ensure that their children, when they're young adults, to get insured, because if you've got a 23-year-old who gets hurt playing rugby on the weekend and can't work, who do you think picks up the slack?
Yeah, yeah.
Mum and dad are picking up the slack
Yeah,
for sure.
exactly.
So mums and dads out there, if you're talking to your kids and they're working, one of your responsibilities now is to get your children to be self-aware around these sorts of issues, and they've got to provide some protection. Even put a bit inside super, they won't see it, but highly important.
Yeah.
Now, what should happen, and then the next sort of step for that is once you start getting debts, you've got to start looking at loading up on your life insurance and your disability insurance and your super fund. Income protection, day one, full-time, just do it. And then once you start getting mortgages and stuff like that, that when it becomes more commonly critical.
Yeah. Now, this could be a bit of a out of the blue question, but just thought of it because you said you should set it up almost from like when you start working. Do super funds have any rules around like how much you need in your super before you can set up like any insurances? Or could you go in with like a $0 balance and set it up as long as there was income going into it?
Yeah, you've got to have, I think the rules are nowadays, you've got to have $5,000 in a super fund, and you've got to have a contribution coming in semi-frequently to make sure that the cover's maintained. But what tends to happen with a lot of super funds is they give you what's called default cover.
Yeah.
And that is that they'll give you, the younger you are, the more you get. So they unitise it. In a lot of industry funds kind of unitise it, and they say, we're going to give you 4 units of life insurance, and if you're 20, 4 units is worth $100,000 a unit. If you're 50, we're going to give you $20,000 a unit. Right?
Yeah, okay.
So what actually happens with industry, this is a good point you raise here, right? With default insurance cover, I hate it inside super funds, is that the older you get, well, super funds want to be cheap, industry funds want to be cheap. That's their primary goal.
Yeah.
Right? So rather than the premiums going up over time and the cover remaining the same amount, they keep the premium the same but automatically reduce the cover. Well, people's need for cover doesn't automatically reduce, right?
Yeah.
But you can go into that super fund and apply for more and retain it. So, that's probably a key thing to remember on that.
Yeah.
So you also didn't talk about the income protection in relation to, is it a deductible debt that you can claim against your income?
Yeah, you can. Yeah, you're right. You can, if you own the income protection in your own name, because you can buy it inside super. I have a preference to buy it in my own name. If you buy the income protection, the premium is tax deductible. It is. Good point.
Yeah, cool. And just back on the reviewing, would you review your like wealth protection every year, every 2 years,
I reckon every couple of years is good. Look, you probably don't need to change it too much. When you apply for insurance, you do got to jump through some medical hoops without an application. Just because you apply for it doesn't mean an insurance company has to give it to you.
Yeah,
You've got to jump through some medicals first, which is normal. I would say every few years is probably fine if circumstances haven't changed.
Yeah.
But once you start having children and getting more debts and earning more money, you should be reviewing it regularly.
Yeah, for sure.
And so do you have any positive stories or negative stories from all the time that you've been a planner for people that have gone down the path of doing insurance or not doing insurance that you could share?
Yeah, I do. Yeah, unfortunately I do. I've got positive stories. I've seen people who have been hit with medical conditions that would just are debilitating to the point where they're alive and they'll never work again, right? So these are nasty things like MS, right? So MS is just a debilitating condition that just I wouldn't wish upon anybody. But I've had clients in situations where they've had conditions like that and they've had considerable life insurance in place that I know they're still living off that today.
Yeah.
Right.
Yeah.
And
Just takes that stress away.
like you wouldn't believe. Like he was self-employed at the time. His wife was trying to, work 2 jobs to try and support because his ability to work was just becoming less and less and less, right? So income was reducing and healthcare costs and everything else. And so I would hate to see how that would have eventuated if he didn't have that pot of money. Now, I have seen that happen as well, where we've suggested it, they didn't want to pay for it, I'm healthy, I don't need it, and I've seen pancreatic cancer kick in within 6 months and mum's left with 5 kids and a mortgage, right?
Yeah.
It breaks your heart, and I would say as a husband and a father, just don't do that to your family. That's the only advice I can give, right? For a few bucks, get it sorted out because it's just hard to watch.
Yeah.
You wouldn't wish it upon anyone.
And to take a bit of the concerns away from some people, have you ever had a situation where something's happened and their claims haven't gone through or have been denied?
Yeah, I have, but not through the fault of the insurance company, right? So I think there's a bit of a misconception there that insurance companies are all arseholes, a bit like banks. They're all just out to make a profit and they don't give a shit. Well, insurance companies, in my experience, aren't like that. Honestly, if they had an ethos like that, they just would not make any money, because I can tell you financial planners wouldn't support them.
Yeah.
It's a bit like broker, though. I think the broker market now, you said to me the other day, is 76% of loans are written through brokers. If banks are going to give clients a bad experience, brokers are just not going to use them, right? Well, planners and insurance companies are the same. So insurance companies absolutely want to pay claims because they're in the business of helping when helping's needed. What they're not in the business of doing is helping paying claims that probably shouldn't be paid, right? So they've got to meet certain terms and conditions of what disability and all that sort of stuff means. But most cases where insurance companies don't pay, I find, is where there's been this what we call non-disclosure. I'm claiming for a bad back, but at the time I applied for the insurance, I told you I didn't have a problem with my back, but all of a sudden you've got a debilitating condition that was always going to lead to claim. You've got to be a bit straight up with that stuff.
Yeah. Well, I feel like that's all our questions, and we've pretty much answered the whole 3 different pillars, don't you think?
Yeah, I think we've touched on.
So now we're ready to go talk about creating wealth and building the nest egg, right?
That's another
So that
time.
might be a fun conversation for another day.
But no, thank you for that. I think that's gone over the 3 pillars pretty well.
Good stuff.
Yeah. And any last words?
Look, I think I touched on this last discussion as well. We've been talking about, that's only 3 topics amongst probably 10 that you're going to deal with in your lifetime. The best tip I can sort of give people is start to learn, ask questions, stress test things, play devil's advocate to stuff. Don't get anchored to one particular way of doing things. And we talked about this before around, I'm a share-based investor or I'm a property investor. That's garbage. You should be both, right? Both assets have got a place to play in your portfolio, and sort of don't be ignorant to opportunities. Above all of that, you've got to get surrounded by the right people and you've got to get good advice. So I couldn't think of a better tip for anybody than be surrounded by good people that are going to guide you in the right direction.
Yeah, cool.
That sounds good.
No, thank you for that.
Yeah, no worries.
And just on the back of this episode, if anyone does have any questions that they want covered, feel free to send them in, and when we get someone like Dan or someone who knows about that topic, we'll cover the questions in more detail. And
Well, I think we'll invite him back for the next stage.
definitely.
We want the wealth creation.
We want to get into the wealth creation for sure.
That's 10 podcasts episodes.
No, exactly. No, well, thank you for helping us set up our foundations.
Welcome,
We need to set
welcome.
up correctly, and that's what we're doing.
No, thanks for that. Right.
Thanks, guys.
Catch you next time.
See you.
This is Money Stories.
brought to you by Amy and Ben from In Financial Services.